Okay, wonderful. I think we're ready to get started. So welcome back to week 2 of the class. I think everybody has done really well on week 1. It looks like the quiz scores were good. It looks like everybody's getting caught up on both week 1 and week 2 assignments. So I think we are getting into the swing of things, even though we have this kind of weird course cycle or weird week ending date. And I wanted to start off, first of all, by announcing the results of the poll from last week. So if you remember, I asked you if you would prefer to have the final chat, which is almost entirely a review for the final, if you'd like to have that earlier than the regularly scheduled last day of class. And everyone said yes. And so the overwhelming majority of you asked or voted for Thursday, February 21st. At 5:30 Pacific, so same time, but we're just going to have it Thursday instead of Tuesday. So this will be instead of. There will be no class that final day. And if for some reason, I know this is not the regularly scheduled night, if you cannot be present for the chat, then obviously you can listen to the recording. And if there's something that you wanted to ask during the live chat that you didn't get a chance to, you certainly can ask me. You can chat with me directly about that, because I want to make sure that you get all of your questions answered. And I know this wasn't the scheduled time, and it's not ideal. It's just kind of weird the way things happen, but hopefully everybody will be able to make it. So
it's the 21st.
21st, yes, that is a Thursday. And so we'll have class on Tuesday, which I guess would be the 19th. I don't have my calendar in front of me. And then 2 days later, we'll have the final chat on Thursday. Okay, so I wanted to make sure that we got that squared away. Tonight we will talk about some leftover questions from week 1. Everyone answered the survey, which was wonderful. I didn't even mention it, so thank you for doing that. We'll address some of the issues that came up there. And then just a reminder, oh goodness, I have got the wrong chat. So bear with me. I'm going to stop sharing for just a second. Hopefully you have the correct chat. You have the correct chat posted to the web page. Just bear with me a couple of seconds here, and I'm going to get. It looks like I'm going to need to pause the recording. I want to make sure that we get the correct information going here, so my apologies for this. So while we are waiting for me to get the correct chat slide going, if you want to kind of fill the time by talking to me about things that you found interesting from week 2, I know people have already been posting to the comment board, or questions that you have that are unresolved.
I had a question, but it's not really, it's about standard and itemized deductions.
Okay.
Okay, in California, I have to do a state return as well as federal. Am I allowed to use the standard deduction on the federal form and itemized deductions on the state form?
Yes, you are. And that was one of the questions from the survey. That's an excellent question. And absolutely. So many states have different rules for a reason, and Arizona is the same way. So I used to have a few clients who would not itemize for federal purposes, but they would itemize for state purposes. And now that the standard deduction is so much bigger, it looks like more people are going to be itemizing. And I am not finding my saved chat, so we may just have to go with the old one. I'll look one more place. I swear I had it. Okay. So I do have the PDF, but not the PowerPoint. So we'll see how this works. Okay, probably not going to be as pretty, but it will work. I'm just going to share this. Okay, so much for being prepared. All right, so we have at least got the PowerPoint here. So homework was due yesterday. I believe everybody now has that completed. And quizzes, both last week's and this week, are due tonight at midnight Pacific time. And so all of your comments, quizzes, homework, all of that should be taken care of weeks 1 and 2 tonight at midnight. Then we'll start over next week. So thank you very much for your patience. And now the 1-minute survey. So we've already taken care of the standard versus the itemized deductions. And yes, I think that will be much more common now that the standard deduction is higher. One other thing that I'll say, I don't know what California has done. I have not been following California specifically, although I'm going to need to get familiar with it real soon. But I do know that Arizona does allow itemized deductions. Not every state does. Arizona does allow itemized deductions, but they have not commented, they have not addressed how they are going to adopt or not adopt the new rules that the IRS has set out. Now, basically, Arizona does say we take federal AGI and we follow federal rules, but the standard deduction in Arizona, it used to be bigger than potentially the federal deduction, but now that could be inverted. So in Arizona, I have individual clients who are asking, do we file tax returns now? Do we wait? And there's lots of stuff in the media. So I don't know if anybody who is in California or in other states who are itemizing, have you heard anything in the news about what your state is doing, whether they have addressed or not addressed, whether they're going to conform to all of the IRS changes or not?
I received a letter from my CPA, and she said that the state of California has not adopted Trump's tax reform. So I can still take a lot of itemized deductions on that, but not the federal form.
Thank you. And that does not surprise me at all, because California and New York especially, were at the forefront of being very unhappy about the state tax deduction that is being limited, and we're going to learn about that next week. So that's interesting to know. Thank you for that. Anybody who is not in California who has seen anything about whether your home state is going to conform or not conform? No, I think most of us are in California. I'm not in California, but most of us are. So stay tuned. Next, we had a question about why is there an exemption for blindness, but not for any other physical impairment? That is a good question, and I don't know the specific answer, but I think when you don't know the specific answer to why something is the way it is, I think it's probably because a lawmaker or many lawmakers had blind family members, and they thought that that was important, that type of disability get an exemption. Unfortunately, that's obviously the way a lot of laws get made, and tax law is no different. And it is interesting that blindness is the one thing that's been singled out. Personal exemption versus a qualifying child credit. So the question in the survey was, last week I mentioned that there are no more personal exemptions, but isn't there still the concept of the qualifying child? And that is true. So there was a section last week, a lot of information about how do you figure out who is a dependent, and if there are divorced couples or separated couples, or maybe grandparents who are taking care of grandkids, or sometimes adult children who come and live with their parents again. How do you figure out who's a dependent and who's not? Still need to know those rules, because you still need to know who's a dependent and who's not. But the exemption, the personal exemption, that deduction, so reducing income, that has been suspended for 8 years. So that is a true statement. Now, there still is the qualifying child concept, but the qualifying child is now for a credit, not for a deduction. And we'll talk about credits more, I think, in week 4 or possibly week 5. Credits are generally better because credits offset dollar for dollar tax. So if I get a $1,000 tax deduction, and I'm in the 25% tax bracket, then I'm saving $250, $1,000 times 25%. But if I have a $1,000 credit, then I'm saving a full $1,000 in taxes. So credits are generally better than deductions, but it depends on your tax bracket, and it depends on the deduction versus the amount of the credit. So that is the distinction there, and it is an important one to make. I would be interested to see if California then is going to continue to have personal exemptions, so personal exemption deductions. So perhaps that will be important for states as well. And I believe Arizona continues to have the deduction as opposed to the credit. So the form will still look the same, and you'll still list your dependents just right under the taxpayer and the spouse's names, just like you always have. And you have to have the social security number, and certainly they have to qualify, but it'll just be different tax attributes for the federal return. So any other questions from last week before we start talking about this week's material? No? Okay. I think everybody did a pretty good job. That was some introductory material, and I think a lot of you have experience already, which is great. So everybody did really well, and I'm not too surprised that there aren't tons of questions. This week, I think everybody has a hang of the general concept of income too. So we will spend some time going through some of the not trickier concepts, but I just want to kind of highlight and amplify a few of the things that sometimes surprise people. I also want to make sure that where there are differences now versus last year, that we make sure that we highlight those as well, because again, the book, and it's the newest book that we have, but it just was published so late They published it as late as they could, but it just didn't have enough information. I don't think that the new tax law is featured as prominently as it should be, as some of you who are trying to do your homework were made aware. And again, I want to emphasize homework is graded for effort. So homework is where we learn. Homework is where you get the tools that you need to do your quiz. So as long as you're answering the questions in a timely manner, you will get your credit for that. Now, let's turn to gross income. So I think everybody is on the same page that gross income for IRS purposes is basically everything. And the IRS needs to specifically exempt if something is not going to be treated as taxable income. And then there are some exclusions as well. But basically, when in doubt, you probably need to put it on the tax return. Another important thing to keep in mind that was highlighted either during one of the homework answers or maybe during the discussion is the concept of reporting income, of self-reporting income. So nowadays, in the computer age, the advanced computer age, the IRS gets so much information reported automatically. So if you have a W-2, it's reported electronically to the government by February 1st. If you get a 1099 for non-employee compensation, that also is reported to the IRS by the first week of February. Interest and dividends, except for very de minimis amounts, those are reported directly as well. So it doesn't do you any good to ignore or leave off those types of income because it's all being reported directly to the government. So one of the reasons that we don't need as many audits as we used to have is because the reporting is just that much better. Everything is electronic, and so you can show them a piece of paper or a PDF copy of your W-2, but they already have that information already. There's less scope for cheating because the income, for the most part, not all of it, but for the most part, is being reported, and so it's just the deductions that aren't necessarily being reported, and that's there's less scope for cheating there, although obviously cheating could happen. But although most income is reported directly to the government, not all income is. And I don't personally have many clients who deal with cash. Most of my clients are service businesses, and most clients take credit cards now. But there are many businesses who are cash-based businesses. My business, I'm a CPA, and I do have business clients, and they are required to send me a 1099 if they pay me more than $600 during the year. But many of my clients are individuals, and individuals aren't required to send me 1099s. So even though they don't pay me cash, it's not reported directly to the government. Just because income isn't reported directly to the government or even doesn't go into the bank account. So I do deposit all checks into my corporate account. So it would be very easy for the IRS to check how much money was going in and out of that bank account. But for those cash-basis businesses where they really are dealing in cash, they don't necessarily have to even put that through the bank account. All of that income needs to be reported. And I believe the example, I think in the homework was interest under $10 isn't necessarily reported to the IRS, but it is interest income. And so that does need to be reported on the tax return. So that's an important thing to keep in mind. It's an important thing to make sure that if your clients ask you about this, not that you'll be preparing returns most likely, but you want to let them know, yes, you need to let your CPA know about all your sources of income and all of your deductions. And for me personally, if I have a client who tells me that they have income, but they don't want to report it, I will say, well, I am aware that you had that income, and if you don't want to report it, then I can't sign your return. And typically I don't have clients it doesn't get to that point because you kind of know clients who want to cut corners, and I try to avoid those types of clients. But if it ever got to that point, I am very clear that, and it doesn't even matter the dollar amount, because if a client If a client said, well, I had $5 of income and I don't want to report it, well, it's $5 of income. How much tax could you possibly owe on that? And that tells me if they want to tell me that they don't want to report something, they kind of want me to approve it and me to take the fall if something happens. So I definitely stay away from that. And we had the discussion last week about the CPA who told one of you just ignore the capital gains. So I think intuitively we know that, but just remember when you're talking to your clients, if they're asking you, well, my CPA said I had to do this or I didn't have to do this, you report as a U.S. citizen, you report your worldwide income, whether it's been reported to the government or not. Last thing I'll say on this slide is that not everybody has to file a tax return. And I think we talked about that last week. It's only if your gross income is greater now than your standard deduction. And for a married couple, that's a minimum of $24,000. It could be $26,300 if both spouses are over 65. So you don't necessarily have to file a tax return. And again, the IRS is going to get Social Security income straight from the Social Security Administration. They'll get a pension 1099-R if a client gets that. They'll get the interest, they'll get the dividends, and they actually can calculate the return for a client. And so they'll see, okay, only $20,000 has been reported, so we know there's no tax due, so we're not going to ask for a return. Okay, next. So I think everybody's got a great handle on what is included in gross income, but I wanted to emphasize a couple of items here. I think we will talk about distributed share of a partnership income in another slide. So I'm going to focus on the income from discharge of indebtedness. So unfortunately, if you or a client has some debt relieved, not in bankruptcy, but just you negotiate a lower payoff of a credit card or a car loan or a mortgage, that relief of debt is considered income because it's an increase in your net worth, right? Because your net worth is assets minus liabilities. If now all of a sudden a liability is gone, you have income according to the IRS. And this is unfortunate because if a taxpayer is in a position to not be able to pay their bills, then they probably aren't going to be able to pay the tax either. So I will hold my thought because I think I saw Chris raise his hand.
Yes. So would this also go with like student loan repayment with like if your work decided to cover your tuition, is that kind of like the same thing, or is that a separate category?
That's a good question. That is separate. So
Okay.
this is a debt. Now, student loans, if you default on your student loans, that potentially could be income to you. But if your employer is paying for school, for instance, for this class, then that is something different. And we will talk about that in just a couple of slides. But thank you for that question. So this is debt. And the thing that I want to make sure that I emphasize here tonight, because the book does not do a good job at all, it is in there, but you have to literally read the fine print. So this is all discharge of indebtedness. So again, it's debt. It's not paying for an expense, but it's debt. So it could be auto loans, credit cards, mortgages, whether that's for rental properties or for your personal residence. Now, some of you may be aware that for several years after the last financial crisis, there was a provision in the tax code that allowed a taxpayer to not recognize up to $2 million of debt relief if it were a personal residence and if it were original purchase debt. So in other words, if you bought a house and then you kept taking money out as the value increased to do other things, that would not be excluded. But if you were just a normal person who bought a house and then you couldn't make the payments, they would call it underwater, and you walked away from the debt, if it were your personal residence, you did not have to recognize that as income. That lasted for several years, and it was extended a couple of times, but it ended on December 31st of 17, which means for 18, for the tax year that we would be looking at now, and certainly that we're studying, and future years, unfortunately, if someone is in that position where they have relief of debt on a personal residence, they're still going to have to pick that up in income. So it can be very unfortunate. I had clients during, this last 10-year period where they had lived in California, and they sold a home in California and had all this cash, and so they bought rental properties, more than one, here in Tucson, because the market was, and still is, much less expensive than anywhere in California, almost anywhere in California. So they had like 3 rental properties, and then the economy got weak, and they were pretty leveraged. They really had to have the properties rented, and all of them rented all the time, and one of them wasn't, and they got into trouble, and it was unfortunate. Now, there are exceptions for the discharge of indebtedness, and that would be if you're insolvent. But to be insolvent, that means that all of your liabilities are greater than all of your assets. And that does include retirement accounts, your home, your car, things like that. And so for that particular taxpayer, they were working professionals. They did have small retirement plan balances, and they owned a house that had a little bit of equity in that they lived in. So they were not candidates for insolvency. They were having a really hard time making their payments, and they were able to negotiate some of that debt down, but they did have a big tax balance due, and unfortunately there wasn't a lot that could be done about it unless they tried an offer and compromise or something like that. And I want to make sure that I'm not missing anything here. Okay, I think I'm good. Okay, so any questions about discharge of indebtedness? Any other questions about that? So the key thing to remember is there is no exclusion for personal residences anymore. So if you have clients that are talking about this because somebody else did it a couple of years ago, that is true, but not available for them anymore, unfortunately. Okay, we will come back to the partnerships because that's also something else that's very important to understand, and something that is really hard for some of my clients to understand. But the next thing I want to talk about is cash basis accounting. So we're in January. Good time to think about it, but I will pause, and it looks like Adrian has a question or comment.
Yes, sorry, real quick, going back to the debt relief. So I'm assuming when this happens, most people aren't prepared for it, so they're going to owe more than they were planning on, so that would require a quarterly payment. Otherwise, they'd also be, maybe a penalty would occur.
So good question.
Nothing's withheld
yes.
on it, right? So
yeah, nothing is withheld. Yes, they are never prepared for it. They never see it coming. The penalty, the estimated tax payments, that could be based on last year's income. So if they were paying in based on last year's taxes, they may owe a lot in April. So let's say this happened in 2018. If their 2017 tax was $10,000 and they paid in $10,000 in tax in 18, they may owe another $10,000 or $20,000 in April, but there will not be a penalty. So that's the underpayment that we learned about last week. However, what usually ends up happening is you tell someone they owe $20,000, $30,000, $40,000 or more, and they say, I don't have that. You can extend your tax return, but that's an extension of time to file, not to pay. And then the 5% and the 0.5% starts ticking until the client can pay that off. And so that definitely can be a problem. And Aaron, I think you had your hands up too.
Yeah, quick question. So if you were to say someone was to renegotiate debt, and so say they had a mortgage for 100,000, they got a loan mod, and somehow they were able to negotiate to get $100,000 relief of the mortgage. So at the end of that, does that generate? Will the mortgage company generate a 1099 for that amount, or how does
They
that
will.
work? How do they report it?
Yes, it's a 1099-C, I believe, for cancellation of debt. And the mortgages are a little bit tricky because it depends on if you're in a recourse state or a non-recourse state, and it depends on the reduction in value. But bottom line, you will get a tax document. The client will get a tax document from the lender, and they do that because if the bank, let's say it's a bank, the lender on the other side, they're writing that down, right? So they're going to get a deduction.
Yeah.
If they're getting a deduction, someone's got to pick it up in income. And so, yes, it is going to the government.
Yeah, makes sense. I figure, I'm sure this is most common with credit cards, but
Yes, that happens as well. Yeah. Okay, good questions. And have I gotten everybody's question? Okay, good. So next thing I want to talk about is Graham, do you another question, or was that from before?
Yeah, kind of a related question. For student loans, for when they're forgiven, I know most of the time they show up on the 1099-C, and you got to pay tax on them. For the public service loan forgiveness program, where they are, in theory, tax-free forgiveness, how does that play into does it just not show up at all on the tax return, or what happens there?
Yeah, so it's my understanding that if you're in a public service or some kind of agreement where, like Teach for America or something like that. My niece went to law school, and she was in a program where as long as she worked for a government or a nonprofit, her loans would be forgiven. And so as long as you are in compliance with your terms, you don't see any of that paperwork.
Got it. Okay, thank you.
Similarly, I guess it's a little bit different with the military because it's not really debt forgiveness. The military pays you the money or pays the school directly. But if you're in a special program, then that's not really. It's called debt forgiveness, but you're not defaulting on the loan, right? It's under a structured agreement.
Gotcha.
Okay, so we'll talk about cash basis of accounting. And this is more important for business clients than it is for just investors or W-2 people, because if you get a W-2, you're putting that on your tax return, and if it's not right, you have to go back to your employer to get that fixed. I have had that happen a couple times with clients, but the IRS, they don't take kindly to you adjusting your own W-2. But if you are a business owner, you have the opportunity to either be on a cash or an accrual basis. Most taxpayers want to be on a cash basis because that means if I have cash, I have the money to pay the taxes. If I did a bunch of work in December and I sent out bills, let's say December 15th, and everybody was partying, and so they didn't send me money until January, or maybe they were, maybe I had one big customer and they had financial trouble and they didn't pay me until May, then I don't have the cash to pay my taxes if I'm on the accrual basis. So 99% of individuals follow the cash basis of accounting. The thing to know here is that cash basis means if the money is available to you, then you must include it in income. And so available to you means I'm a business, and if clients mailed me checks, which doesn't happen as much anymore, but some do, mailed me checks, and the check was in my mailbox, my corporate mailbox, on December 31st, I had access to it. If I decided not to go to the office that day and ignore it, I still had access to it. So I need to pick up the income in 2018 if that happened last year. On the flip side, if you're a business owner and you realize that you had a great year and you want to pay some expenses, you want to buy some equipment, make sure you get all your bills paid, as long as the check leaves your possession or you've hit the bill pay button or you charge your credit card by December 31st, as long as you can't, hold that or, just change your mind, then that deduction is allowed for that year as well, in this case, 2018. So it's important to remember that. One other case of cash basis accounting or the availability of funds that we'll see is if something is in escrow. So if you have money and it's in a trust account, for instance, if you have attorney clients, it's in a trust account, and that's really not the attorney's money. It's being held, and if they don't bill for it or if they don't execute according to the terms, the money has to go back to the client, then that's not income to them while it's in the trust account. If you have a sale of real estate and for whatever reason the money's in escrow and you cannot get it out at December 31st, then that is not a taxable transaction to you that year. And when we talk about 1031 exchanges, we'll talk more about escrow and how that becomes important. But that's another example of cash or income not being available to a taxpayer. Any questions about cash basis of accounting? The last thing I'll say about that is sometimes you will see a 1099 for dividends and the dividend actually doesn't hit the investment account until January 2nd or 3rd or something like that. Even though this is like a W-2 situation, even though on a strict cash basis that wasn't taxable income because it wasn't in your brokerage account, because it's being reported to the government on a 1099 DIV, you're probably better off just going with that number and not trying to back it out. You know, if there were serious issues, if it's not a W-2, there are ways that you can fix it. You need to report that gross number so the IRS can match it up, but you can back things out if you need to. Typically, though, for that type of income, you would just go with a 1099. I think in this class, everybody's familiar with the qualified dividends, preferential treatment, and you only have to hold it 121 days, so it's not even a whole year. This, you may find it interesting. Well, I'll ask the question, does anybody know why this rule exists and approximately when this rule came into law? Anyone want to guess? I will give you a hint. It was in the late 90s, early 2000s that this became law. I'd say early 2000s.
This is a wild guess and it's probably wrong, but just to encourage people to keep their money invested for a long period of time. That
is 100% right.
Okay.
So this was after a market crash, and up in the late 90s and early 2000s, there was a lot of day trading going on. I mean, a lot of day trading going on. And so Congress decided to pass this law saying that if you don't hold your stock, if you only hold it for a couple of days, I mean, people were literally buying in the morning and selling in the afternoon. And Congress wanted to discourage that behavior, and so that's how this rule came into being. And I will say I was a little bit surprised. So this, I think it was probably 2002, 2003 when this became law, and all of that package was supposed to sunset in 2010, and the whole package got extended a couple of years. And I really didn't think that this would be extended because it's a pretty nice tax break. I was preparing taxes before this became law, and in the financial services industry, you have clients certainly who have a lot of dividends, a lot of qualified dividends, because if they're working with you, you're not churning them. And it's a significant tax break. I mean, if you are looking at now the 37% tax bracket, but it used to be 39.6, and you can get even a 23.8% if your income's over $250,000. That's still pretty nice. And if you have tens of thousands of dollars of dividends, it's a pretty nice tax break, and it seems to be holding. So Kevin, you're 100% right. That's exactly why they did it. So now you know. Sometimes it does make sense what they do.
So when this law was passed, was it only around the qualified dividends, or did this also when they brought in the differentiation between a short-term capital gain and a long-term capital gain, and
So,
how those the difference and how those are taxed as well?
yeah, so short and long term, those have been the law for a long, long time. It was way before my time. Yeah. But the qualified dividends, it was a big package of tax cuts. They cut they made the qualified dividends a thing. They cut marginal tax rates, so ordinary tax rates. I was trying to think, I was kind of stuttering. I think they actually cut the capital gain rate as well. So short term was always taxed at ordinary rates. Long-term capital gains for the longest time had a preferential treatment. But when I started 23, 24 years ago, it was 28%. So in this 2002 package, they reduced the capital gains rate. And they did some things with bonus depreciation. So it was also a time of recession because this was after 2001, 9/11. And so, the market had crashed and there was a bit of a recession. So there were a lot of tax cuts. It was the biggest tax bill since probably 92. So it goes about like in 10 years, 92, 2002, 2018 was a big one. That's a little bit longer than 10 years. So there were quite a few things going on. But that's, that question raises an important issue. So one of the discussion threads that I am enjoying following revolves around how do you position assets in a portfolio, right? So if you have regular interest, you want that to be in your tax deferred account because that's going to be taxed at the highest rate. If you have muni bonds, you definitely don't want that in your tax deferred portfolio. So you want that in your regular portfolio. And then there's the growth stocks. And so do you want those? You probably want those outside because you want a preferred capital gain treatment as opposed to it growing. And then when you take it out, it's taxed at marginal rates. But when you are making this evaluation, it's not static. So every time there's a law change, you have to decide, okay, where's the best place to put this income? And so as capital gains rates change, as qualified dividends come in and out, as we have qualified business income, so with qualified business income, which we'll talk about in week 6 or 7, do you dump a bunch of money into a qualified plan, or do you let the qualified business income deduction kind of eat some of that up? So as tax laws change, you have to be thinking about where is the best place to deploy this capital to really give the client the biggest net worth, right? That's what your goal is for your client. That's what your goal is for yourself. That's what my goal is for myself. I am saving for retirement so that I don't run out of money. And so sometimes that means paying taxes, but that also means being tactical about how I save and how I invest where I'm saving. So I look forward to more comments on that discussion thread and more thoughts about that. Next thing that I want to talk a little bit about, this is a little bit tricky as well. Oh, somebody's got a hand. Graham.
Yeah, right. Question about the QBI. So with a sole proprietor, if you're putting money into a Roth or just a traditional or a solo 401k, and that's kind of coming off of their AGI, are they still getting? Have you seen that they're still getting the QBI deduction even for that amount that's going into the tax deferred account?
Well, it's a little bit complicated. So and we'll talk more about this when we talk about businesses, but the straight 20%, that you don't factor in your retirement plan deduction. So the 20% is based on that Schedule C number that used to go to line 13. I can't remember what line it's on now because all the forms have changed, but that bottom line net profit number.
Got it.
But there's a separate, so it's 20% of your income from your business, but there's also I think it's still 20% of your total or your taxable income. And so if your retirement plan is reducing that. And so depending on if it's just the business and you don't have a spouse that's working and you don't have investments, then maybe that deduction is going to diminish that 20%. But if you've got a spouse that's working or you have other things going on, then maybe it doesn't. So it's, unfortunately, I can't give you a straightforward answer. It all depends on the numbers. But we'll talk more about that in a future week.
Okay, thank you.
You're welcome. Okay, so let's talk a little bit about annuities. There is a quiz question, and I'm not sure if I have it on the final exam and the midterm, but still it's important to understand how annuities are taxed. So we are going to look at a math problem about someone who is annuitizing like a traditional, either over a lifetime or over a period certain. But if you have clients who want to take money just a little bit out of an annuity, if you are not taking annuitized payments, it's always going to be income first. And the other thing I'll say about annuities is it's funny, every time I think about annuities, I think about tax qualified annuities, and I think of them being 100% taxable, which isn't always the case, as I'm sure you're all aware and probably think of all the time. So this is an exercise when you have a client who purchases a non-qualified annuity. So this isn't in a retirement plan. So there's going to be some cost basis in there. And then of course the contract is going to grow. And then as the taxpayer or the owner annuitizes or takes money out, some of it's going to be taxable, some not. So again, if it's not a regular systematic, it's earnings first. But if it's annuitized, whether it is period certain or life expectancy, then there's going to be a calculation that you have to do. And I will say you don't have to do it. The annuity company is going to do it. They'll send you a 1099. But as you're planning, okay, where do we start taking money as you're retiring? It's important to understand how that calculation is going to work. And Graham, did you have a follow-up? I'm guessing no. Oh,
I have to take that. I'm sorry.
that's okay. No problem. Okay, so let's take a look at the annuity problem here. So in this example, client invested $25,000 post-tax, decides to annuitize the contract at the beginning of the year, and the client will receive $125 for a period certain. I think most clients probably they elect life expectancy, but this just makes the math easier. If it were life expectancy, then you would go to you would say the client is X years, and you go to a table and you get a life expectancy, and maybe it'd be 20 years, maybe something different. But what we want to do is I have the formula outlined here, but the way that it's easier for me to think about it is $25,000 is my cost basis. I'm going to use that over 20 years. So I'm going to divide 25 by 20. That ends up being $1,250. That's my non-taxable portion. $125 a month is $1,500 for the whole year. And so $1,500 minus the $250 is the $1,250 is $250 taxable. Aaron, you have a question or a comment?
Yeah, so just going back to so if someone annuitizes and they're going for life instead of period certain, yeah, life expectancies, are we utilizing the same life expectancies that you would use for when you're calculating RMDs for IRAs?
That's a good question, and I am not certain that that is the case because there are different life expectancy tables. So I would, you know what, I'm going to make that a research question. So anyone who can find that answer for me, you can post it to the discussion board and I will give you extra credit. And if if no one finds the answer, I can look it up easily, but I have a feeling that it is not the same.
Okay.
So I'm going to make a note of that. Because really, if you think about it, the RMD tables, they don't change that often. And I think that I don't know that insurance companies change their life expectancy tables every year, but I think they probably change it more often than the IRS does. Okay, so that is our annuity taxation example. Questions about that, the calculation? No? Okay. So now pass-through income. Another thing that I want to make sure that you understand. And so I'm going to give you an explanation, but the one thing that I want you to remember is distributions do not necessarily equal taxable income. And money coming out of so I have a client who is a sole S Corp shareholder. He's been an S Corp owner for 10, 15 years, and he consistently calls it a dividend, and I've stopped correcting him. So if you are an owner in a partnership, an LLC, or an S corporation, sometimes those owners will say, I got a dividend because I got money from the company. These entities do not give dividends. Dividends are like the things that could be qualified or non-qualified. They come from C corporations. So if you are in a pass-through, you get distributions, you do not get dividends. The distributions that you receive may be very close to your taxable income, but they almost certainly will not equal your taxable income. And depending on what kind of business you run, they may have no relation to your taxable income as well. So again, in week 6, we'll talk about business entities. We'll talk about how businesses are taxed. But when you are running a business, for those of you who are small business owners, you know that sometimes you need to leave profits in the business. And for us as service professionals, maybe we don't need to leave as much in the business because we're not capital intensive. But if you think about somebody who is a manufacturer who needs raw materials, a store, a retail outlet that needs inventory, sometimes you need to leave cash in the business. Or maybe even as a service business, you could be moving into a new space, and rather than financing the tenant improvements or the new furniture, you leave your profits in there so that you can buy the materials, the labor, the things that you need. So what that means for tax planning is if you are sitting down with your clients in, say, November, and you know that they are partners in a partnership, and you say, do you have any sense of what your income is going to be for the year? And they say, well, I haven't gotten any distribution or dividends. They may say dividends/distributions. So I'm not going to have any taxable income. That is not necessarily a true statement. And it's difficult because some owners are very in touch with what's going on in their businesses. And certainly if they're sole owners, they have a sense of what the profit's going to be. But this could be, we could all be members or shareholders in an S corporation. And Kevin, you could be managing the business, and we could just be silent investors, and we would have no idea what's going on, and we may not even care. And so it's difficult sometimes to get that information from clients, and that can make tax planning really tricky. So again, pass-through income, distributions does not equal taxable income. We will talk more about it in week 6, but that's something that's very important. And even if you can't explain it, even if you aren't able to help your clients calculate what it's going to be, just the fact that you can let them know that's not always a true proxy, I think is very valuable. Anybody have experiences with clients, or maybe you yourself have a pass-through and had an experience where the taxable income was very different? Maybe it was less, maybe it was more than the distributions they received. No? I heard a story about a client, and I'm sure this happens fairly regularly, where there's a family-owned business, and a husband and wife within the family-owned business got divorced. So let's say it was the husband's family, And in the divorce, the wife decided that she wanted the interest in this family business because, according to the story, the wife just wanted to be an irritant in this family, even though they were parting ways. Well, the family decided that they would have the last laugh, and they decided that they weren't going to distribute profits from this S corporation, and it was fairly profitable. But this family had, other resources, and they were able to pay the tax burden on their share of the income. But they decided that they just weren't going to take distributions. And so the ex-spouse, who is not part of the family anymore, but is now a minority owner in this business, had a bunch of income, and she had to find other resources to pay the taxes. So we've, in the discussion board, I know some of you work with divorcing clients. That's something to keep in mind. It is a financial consideration, but it's also, and it's an investment consideration, but it's just I don't know, what would you call it? A human nature? A human nature consideration. You may think that you want to be an irritant to your ex-in-laws, but it can end up backfiring on you sometimes. And I don't know, I think, Jennifer, you are the divorce specialist. I don't know if you have any stories about business owners that got crossways after a divorce.
I don't have any stories, but I usually remind people of just that. Do you want to be constantly connected to your ex or the family or the whatever? Let's do some planning around just being paid out a lump sum and be done with that. So it mostly is emotional. They mostly want that connection because it's emotional.
Yeah.
We don't necessarily want to stay in the business.
Right. Thank you. Aaron.
I was going to mention, I think I found the answer to the annuities. So utilizing IRS publication 939, it appears that when you hit age 65, for immediate annuities, so when you annuitize, they give you a multiple of 20, so the life expectancy of 20 years from 65.
Oh, wow. That is a different table. Yeah.
And then it also appears that if you exceed that, then your annuity payments become fully taxable.
That is true. Yes. So if you exceed your life expectancy or the payout time frame, then you've used up all your basis, right? So it's completely taxable. So thank you, Aaron. Extra credit for you. Okay. I think we've done enough with the pass-through. We talked about discharge of indebtedness. I think everybody's pretty good on the excluded income. So let's talk a little bit more about scholarships and fellowships. We had a question about that at the beginning. So there are a couple of ways that scholarships and fellowships are non-taxable. If you have an employer who has a qualified plan, so it's not a cafeteria plan, but it's kind of akin to that. So the employer has to have a document and keep everybody the same. You can have up to, I think, $5,200 a year or something like that in assistance that is non-taxable. Anything above that is included in your income, which, if you think about it, is not such a bad deal. I mean, if you were going to have to pay $10,000 for tuition, and now you're only paying $2,500 the tax on that, then perhaps that's still a good deal. But if you have an employer that has that plan in place, some of that tuition burden will be lifted.
Do you guys already eat?
Please
I think we're going to mute everybody here. I'm going to try to mute everybody here. Okay, good. So having your employer have that plan in place will make some things non-taxable, or some portion non-taxable. In addition, if you are a TA or if you have a job with the university where you get some sort of tuition waiver, that is non-taxable. If you are in the military and you have GI benefits, that is not taxable. So there are a few ways that you can have your school paid for that are non-taxable. If you don't meet one of those requirements, then it is going to be taxable to you. And one of the discussion threads that we talked about was earned income and de minimis fringe benefits and what has to be included in your income. And the thing to keep in mind with both the education benefits and the gift cards and the non-de minimis fringe benefits is the IRS really does not like you to give your employees benefits, things of value, that is not subject to payroll taxes. So our focus here is income tax, and it is true that $100 gift card really is supposed to be included in your W-2, and you really are supposed to pay income taxes on that. But they are concerned more about payroll taxes. And there was another discussion board thread going on about Social Security. So payroll taxes is a separate trust fund, and that's how we pay for Social Security and Medicare. And the IRS really does not like employers trying to give compensation and not pay into that fund. Because remember, as an employee, you are paying 7.65%. Your employer is paying that same amount. So that's money that's not going into the trust fund. Now, it seems a little Mickey Mouse, right, to make your employer put a $100 gift card into compensation, but that's where the line has been drawn. And I actually went to a presentation, it's been about 2 years ago now. The woman was an attorney. Earlier in her career, she worked for the IRS, and then she left the IRS and went to work for larger clients. So Fortune 500, 1,000, bigger clients where a $100 gift card to each employee really would add up. And she told the funniest stories about how capricious actually the IRS can be when they're determining what is de minimis and what isn't. She said that one employer, that she was representing, so she was representing the taxpayers, gave a gift certificate that was enough for movie tickets and popcorn. And the IRS allowed the portion that was for the movie ticket, but not for the popcorn. And I can't remember the reasoning why, but it was kind of like a ridiculous reason that made no sense. But the rules, the IRS rules are clear. All of it really needed to be included. It was either it's de minimis or it's not. And so the agent was doing whatever he was doing. And then it was up to the taxpayer to hire this woman who was speaking to try to argue about that. So it's interesting what the IRS wants you to include in earned income, and many of you have expressed your feelings about that. And I will also say, I used to talk about the gift cards and like the turkeys and the stuff like that, and every class just about someone would say, well, I got a gift card and my employer didn't put it in my W-2, and I'd say, well, that very well could be. I don't doubt that, but that doesn't mean that it shouldn't be there. And sometimes people would argue, well, I got a turkey and I like ham or something like that. But in this latest Tax Cuts and Jobs Act, there actually was a little bit more in there, really solidifying the position that, yes, even gift cards, even these small things need to be included in income. We did have quite a discussion going on there, but anything anybody else wants to say about de minimis fringe benefits or earned income? Okay, we will move right along there. I want to talk a little bit about earned income. If you have clients, if you're living in California, you may well have clients who are working for larger companies and end up overseas at some point. And if you have clients who are working overseas, there is a potential for some of their income to be excluded from U.S. taxation. But it's not the easiest test to pass. You can be a bona fide resident, and that basically means you have a driver's license there, you've basically given up not your citizenship, but you don't consider yourself a U.S. resident anymore. That's one way to get the exclusion. The other way is to have a physical presence. That means you can't be in the U.S. more than 35 days in a calendar year. And I have had clients, I currently have a client who counts the days. The client that I have now, fortunately, his wife is with him. Their children are grown. And so he can fairly easily meet that test. But in the past, I've had a client, so we're here in Tucson, about 70 miles from the border, who worked in Mexico, and his wife stayed here. And they really had to be careful about how many days he came across the border, and she would go and, meet him in Mexico. They really had to work that out and negotiate it. So it's not the easiest thing. Not everybody can do it. I have a client who's not a pro basketball player, but like a continental basketball player. And so he's in Europe most of the year, but he comes back in the off season. He does basketball camps and stuff like that. So he does not qualify for the earned income exclusion. Also, it's not everything. It's only like $110,000, $120,000 if you consider the housing allowance. And while that may seem like a lot of money, and certainly it's not to be sniffed at, if you have an overseas assignment, typically if you were making $80,000 here, you're easily making $120,000 in your country that you're assigned to, because your income gets grossed up for the differential in tax, because especially if you're working in Europe, the tax rates are much higher. And then, of course, you're taxed in the US as well. And some of the other benefits that you get are taxable. So for my clients who have that earned income, that foreign earned income, typically not all of their income is excluded. But for those who qualify, not paying taxes on $110,000 or $20,000 is pretty nice. The last thing I'll say about that is, if you have a client that, let's say, has $200,000 in foreign earned income, and they qualify for that exclusion of the 110, the exclusion comes off the lower brackets. So let's say they have $80,000 of earned income that is not subject to the exclusion. That's not taxed at 10%. That's taxed at 22 or whatever the marginal bracket is. And that can sometimes be an unpleasant surprise as well. Questions about foreign earned income and the exclusion? Has anyone ever seen this before, either in the family or with clients who worked overseas? No? Okay. We'll talk Aaron.
Oh, sorry. I was just saying that, yes, I have seen it.
Oh, okay. And did your clients, they qualified then?
Yeah, they did. They were from Taiwan. The husband mostly was in Taiwan, and that's where he worked, and that's where all his lived. But his family lived here, and he would only come very periodically to visit his family.
Yeah, that can be difficult. Okay, thank you. Okay, so let's talk about the fringe benefits that are not de minimis. So these are the benefits that I think everybody is fairly aware of just from being an employee. These things can be pre-tax, which is nice. And, I get a lot of clients all clients, of course, are asking, how can I save on taxes? I get a lot of W-2 employees, and there's really not a lot, especially with the latest tax law changes, there's not a lot that can be done for W-2 employees. And so my suggestion is take advantage of all these fringe benefits that you can. Maximize your deductible retirement plan through your employer. If you have an HSA and your health makes it sensible. And that's where financial planning comes in. Do an HSA for sure. If you really need better, more adequate coverage than the high deductible plan, then maybe go with an FSA. Make sure that your health insurance premiums are pre-tax, although I think just about everybody does that now. And then we had some homework questions about disability insurance. And so I'll throw a question open to the group. Which is better? Do you want your disability insurance to be pre-tax or post-tax? If your client came to you and said, I have the option, what should I do? What would you advise?
Post-tax.
Post-tax?
And that way the benefit paid is not taxed.
Exactly. Yeah. And so if you have a choice, absolutely you want it to be post-tax, because that benefit's going to be magnified. Because remember, by law, the maximum disability insurance you can purchase is 60% of your income. So if you don't have to pay taxes on that, that gets you a lot closer to replacing 100% of your income. Not necessarily all the way there, but it gets you closer. So if you have a choice, that's great, but sometimes you don't. Sometimes it's my understanding if the employer pays it, either it's pre-tax for everybody or post-tax for everybody. You can't pick and choose. And so employers typically will make it pre-tax or non-taxable to them. And I don't know, my experience, I think short-term disability is often offered through employers, although not all the time, but long-term disability, I don't see that as an employer offered benefit. I don't know if anybody else has observed anything different in the benefits arena. Okay. So those are our fringe benefits. And then the de minimis, the things that you do not have to put onto your W-2, the small things, office supplies, snacks, the stuff that has your company's name on it, and tokens of sympathy. You don't have to keep track of the value of that. One thing that you'll no doubt see with your clients if you are managing investments or doing comprehensive planning is clients with stock options, especially if you have any clients in Northern California. And so I want to make sure that we cover the two different type of stock option plans. There's qualified and non-qualified. So qualified are also known as incentive stock options. I don't see these as much as I used to, and I think that since 2001, and I think that has to do with a change in the SEC rules about how publicly traded companies can compensate their employees. But they do exist, and incentive stock options are nicer from a regular tax perspective because when an employee receives the options, there is no regular tax consequence. There are some AMT potential consequences, but with AMT reform in the new tax law, that's less of an issue. And we'll talk more about that in a couple of weeks when we talk about AMT. The non-qualified stock options are by far what I see most often. And they have some tax consequences. So when you exercise that bargain element, so a non-qualified stock option means if the stock is trading, well, you get to buy the stock for X dollars, let's say $80. And so you can choose to exercise that option at any time, but typically you're going to exercise it when the stock is trading above 80. So let's say stock's trading at 100, you exercise your options for $80 a share. That $20,000 that you didn't have to pay, that is an ordinary income subject to payroll tax. It's compensation. So not as great a tax benefit. I mean, it's still better. Again, if you're picking up $10,000 in income, you're paying payroll taxes and income taxes, but that's less than 100%. So you're still getting some benefit. After you buy those shares, you do have to hold them for a year after you buy them. And you have to have them for 2 years, beginning with the grant of the option. So there's like a 2-pronged test there. And then you get your long-term capital gain treatment. So at least with non-qualified stock options, you can control that, right? You can exercise or not exercise. You don't have to exercise, and then the income doesn't appear in your W-2. But some of you may have clients with restricted stock units, they call them, and those you actually don't even have any control over. So when restricted stock vests, it becomes compensation, and there's just nothing to be done about it. The good thing is when they vest, you actually do get the cash, so you do have the wherewithal to pay. But if you're trying to plan with your client, you can't control the RSUs. You can control the non-qualified and the ISOs. Yes, Aaron.
Yeah, so on a say you got one of the restricted rights award for stock. So once those fully vest, they just become, it's taxed as income. You can't hold on to them and later sell them for like a long-term capital gain.
Well, so you can hold on to them. So that's an excellent question. So the restricted stock units, if the plan allows, then they do become shares, and you can hold them. So certainly you can hold them, but the taxability, so the value at the time that they vest, you can't control that.
Yeah. So I'm curious, it even applicable to me because my company gave us all restricted share award last year, and they vest over 2 years. But my question, so say they vest February of 2020. Is that where your cost basis would be on that date? And so then if you held it till say March of 2021, your capital gains will be based on the cost basis of when you were fully vested, not when they were awarded. Okay.
Yeah. Whatever's in your W-2. Yeah.
Okay.
Okay. And then I'm not sure if that was Adrian or Aaron, but whoever's still waiting. I think Adrian.
So when they vest, though, I think that's when you owe taxes on the difference from when they were granted to when they vest, and then you get a new cost basis to when you then sell them. And I think a lot of companies give you the option to pay that tax either in shares or in cash.
That is true, and in my experience, almost always the client will sell at least enough to pay the tax, and quite often they will sell all of them because I work a lot with financial advisors, and the financial advisor will say your human capital is at your company, and you're getting a series, typically it's a series of restricted stock, non-qualified options, what have you. And perhaps that's a concentrated position. Maybe not. It depends on the size of your portfolio and the size of your grant. But most of the advisors that I work with will advise for investment diversification purposes. They'll advise that you sell immediately. But you are correct. You certainly could write a check for the taxes, and you could keep all of the shares, or you could sell enough to pay the taxes, keep the rest, or you could sell the shares as soon as you receive them. And if you do that, whether it's non-qualified stock or restricted stock, if you sell them immediately, typically what happens is you have a very small capital loss because your cost basis is coming in your W-2 and you're selling immediately, and there's usually a transaction fee. So if you sell immediately, there's typically a small loss, but you can hold them and get that capital gain. Does anybody, so some of you have experience with options that you're receiving. Does anyone work with a lot of clients who get these stock options, do a lot of planning around that?
Yes, I work with a lot of clients who are executives for businesses, whether they're a CEO for a smaller company or sometimes I have a C-level executive for a larger company and have stock options in very high concentrated stock positions. Mm-hmm. So we do a lot of planning with them when we're planning their retirement on ways to mitigate their large concentration in stock without taking a huge tax liability by just selling it all. Because there are a couple different ways. There's actually some products you can utilize to help leverage out of huge stock option liabilities without making a big tax liability.
Okay, great. And I think maybe you had posted a little bit about that too on the discussion board, didn't you?
Yeah.
Yeah. Okay, good. All right. So let's see, we're getting close to time here. Let me make sure that we get through everything. So Social Security, this is the formula. I'm not going to go through the formula because it's fairly mechanical. But I will say, you probably saw it on the quiz. You will need to see it. You'll see it again on the midterm. You'll see it on the final. I can't predict what you will see on the CFP exam, but I think it's a pretty sure thing that you will see this on the CFP exam. So make sure that you understand how to calculate it. I will also remind you this is an open book quiz, and even the final is open book. So it is okay if you want to check your work using an online calculator. I will say I've tried out different, like free online calculators, and I don't always get the same number. So I wouldn't just blindly type in your numbers. I would try to do the math on paper, but feel free to use help to check your work, at least in this class. But do know that this is fair game for the CFP exam for sure. And I think everybody is familiar with, if all you have is Social Security, then it ends up being non-taxable. And if that's all you have, then obviously you wouldn't have to file a tax return. And that potentially would make you eligible to be a dependent of another. So just to summarize what we've talked about tonight, generally all income is taxable unless it's specifically excluded, but there are many exclusions. So when in doubt, definitely research. Okay, thank you for hanging in there with a very rocky start. I apologize for that. It was a very big surprise. Just a reminder, all week 1 and 2 work is due at midnight tonight. Everybody's really on track for that. Our final chat is going to be Thursday, February 21st instead of the 26th. That class will be canceled. So the 21st will be our final class. I will stay online as long as anyone has questions. Otherwise, have a good week, and I will see you next week.
I have one more question.
Sure.
It's about Social Security. If that's your only means of income, you don't have to file a return. Is that a new law in 2018, or has it always been like that?
No, that is not a new law. That has always been that, well, as long as I can remember, it's been that way. So the formula that we reviewed, that is how you determine, how much of your Social Security is taxable. And then it has always been the case that if your taxable income is under, it used to be your standard deduction and personal exemption, but now it's just your standard deduction. That has always been the case. In fact, there used to be a publication called Thank You for Not Filing that was back like when you filed on paper, that encouraged people not to clog up the system if they weren't going to be producing any revenue.
Okay, thank you very much and good night.
You're welcome. Good night.